Okay, so we are live now, Vivek. Let us wait for a couple of minutes for people to join in.
Sure.
So we do see a lot of people joining in. We'll just wait for another minute maybe before we start.
Sure.
So, good evening, everyone. Hope you all are doing well. Welcome to yet another Good Luck webinar. Today's webinar is a little special. We are going to be discussing all about financial planning for people in their 20s. I am personally very excited about this topic because I am also in my 20s and I know that it can get a bit overwhelming to manage your finances, especially when you're just starting out. So I believe that this webinar will help a lot of people out there, including me, to simplify things a bit. For today's webinar, our speaker is our very own Mr. Vivek Sharma. He is the investment head at Gullak. He has an experience of more than 20 years in the field of trading and investment management. Welcome, Vivek.
Thank you, Simran. Looking forward to interacting with everyone here.
Yeah, so are we. We would first be starting out with a candid discussion with Vivek about financial planning in 20s, and then later we will open the floor to you all to ask questions and get advice from the expert himself. So, Vivek, to start us off, it would be great if you could share your personal finance journey. How did you start in your 20s? What challenges did you face? And would you want to go back and maybe change some things that you did differently?
Yeah, definitely. I did a lot of things that I would want to go back and change. But starting, I'm actually an engineer by education, but stock markets always, I was always interested in stock markets. So even during my engineering days, at that time, we just had one website, Money Control. So I and a couple of my friends used to track the stocks that we wanted to track on money control, and we created a portfolio. So I was always excited by how stock markets work, how the prices of individual stocks move. So after passing out, and I got an opportunity in a trading firm, Futures First, and there I stayed there and traded purely intraday for almost about 10 years. But during that time, I really did not understand investing because trading and investing are quite different fields. And although I had been investing since almost 2004-5, so it's been about 20 years since I've been investing. But the first 10 years when I was trading, at that time I really did not understand investing, and I ended up making a lot of mistakes that I now currently see a lot of people making. And some of them are, I very clearly remember one of the stock. It was a pharma company where I and couple of my friends thought it's a good company, and there was no really basis. We had just heard some rumors, did some own research on internet, which was very basic, and we thought this company could do well. We took a very concentrated bet. So that is one of the first mistakes that I remember, that we took a very heavy concentrated bet on one single stock, and we were lucky. It worked out well in our favor. We made some decent money, what with whatever little capital we had, but we learned a wrong lesson. Actually, we thought that this is the way investing works, and this is uh, it is actually very easy. That's what we learned from that specific mistake. Again, in 2008, I remember when the stock markets fell due to US mortgage crisis. At that time, I was investing uh, a lot. Means I was actually making a lot of market timing bets. So I was lucky in the sense that I was able to catch the bottom of the stock market pretty well. But then the stock markets, when they recovered, I booked profits pretty early. I booked maybe 100 on many stocks. I booked anywhere between 100 200%, but then I kept seeing them move up, and they have given 5x 10x from there, and I just waited for them to correct back to enter. So again, I used to do a lot of market timing. I used to do a lot of individual stock picking, which I think in the long run has really worked for individual investors. I had no idea about asset allocation. I think that is, and even now I don't see a lot of discussion around allocation. And most of the people, when they ask me, it's mostly about what stock or what sector is going to do well. Yeah, so those are some of the mistakes that I would want to go back and correct if I could.
Yeah, thank you for sharing your journey, Vivek. And the other mistakes that you mentioned, we will surely touch upon that as we progress in the webinar. So now everyone has these plans on how they would how they would spend their first salary. Now I remember when I received my first paycheck, I spent it on buying gifts for my family, for my friends, and for myself. And unfortunately, this practice continued for quite a few months where I was not tracking my expenditure at all. And then I realized that I'm not saving much enough. So why is it crucial for us 20 somethings to get our budgeting game on point right now?
Yeah. So, Simran, this is another mistake that I did in the first few years of my investing journey. Uh, so, I also, like you, I also, from my first salary, bought gifts for my family, extended family, and for myself also. But that is not a mistake. I think all of us have those dreams. So, that's a good thing that you did that. But I think what happens is after that, we because we never track our expenses, where our money is going, and we are unable to keep a good track of it. And what happens is we get into overspending and develop wrong spending habits. All of these things happen. So I think for long run, it is not a very good practice. Obviously, if you are able to track, if you are able to budget as to your maybe three broad categories, what are your needs and how much you should be spending. And obviously you can't avoid that. That is something that you need to spend. But then there are your wants. You want to travel, you want to buy an iPhone or things like that. And obviously you want to spend some amount in your wants also, but to control it is I can understand it's very hard, but it is important. And the third bucket is your savings and investment. So if you are able to budget it, if you are able to track all of it, I think that would help a lot of youngsters plan out their goals pretty well. That is one thing. And I think uh, another mistake that most of the people make, I've seen them, is ki, my salary currently is very low. I have a lot of obligations. I want to spend on all of those things, and maybe I'll start saving from next year or when I get a salary hike. I think that is a mistake, because what I feel is I've seen some of the investors, they have started, and even though their salaries were not very high, but they started very small. I think the important thing is to start. The amount you are able to save is really not that important in the beginning, because no matter what, because of your financial obligations and because of the other number of other things, in the early 20s it's very hard to build up a substantial corpus. But what is important is you build up a good habit, a habit of saving, a habit of investing, and a habit of tracking all your expenses. I think just to start building that habit, to get into the discipline of investing and saving, I think everyone should start. Maybe not from first month, but at least definitely from the first year. And it really does not matter how small it is. The important thing is you start. You start putting it some money for your multiple long-term financial goals. That is what is important. The importance of starting out, no matter how small it is. But personally, see, I even myself, I remember I struggled a lot with budgeting. And for me, I think what worked for me wonderfully was not really budgeting, because I was very bad at it. I was not able to track. I wasn't able to keep a discipline. But I changed my view from actually budgeting to paying myself. So then what I did was I opened a separate investing account, and every month, as soon as I used to get my salary, I used to transfer some percentage of that money to investing account, and rest I would manage. So, so what happened is I got into a habit of saving, and secondly, I did not really required so much to track my expenses because I know this is only what I have. Obviously, I've got to fulfill my needs, but for my wants also, this is the money that I have, and rest everything I have already saved. So I think that specific habit of paying myself first and putting some money in that investing amount really helped me build up that discipline of investing every month.
Yeah. So, what according to you is the optimal ratio split between savings and expenditure?
I think it's very personal, and that's why it is known as the topic is personal finance. It's very personal. So I've seen something like a 20-80 rule, which I think is a good starting point in which 20% of your overall salary, post-tax salary, is what you should be saving, right? But then it becomes very personal for some people with, let's say, salaries on the lower side and they have very high financial obligations towards their family, they might not be able to do even 20%. Whereas for others who are lucky enough to get a good job in the beginning and don't really have very many financial obligations, might be able to save even higher. So I think there's no fixed rule as such, but I think 20% is a good starting point. Another point, what is very important is we keep on getting our salary hikes almost every year. And what I've seen is lifestyle inflation, which means your expenses are going uh, up by same percentage or even higher than what your salary is doing. So let's say you get a raise of 15% and your expenses actually go up by 20%. So it really doesn't help you really so much, right? So I think another rule that helped for me was all throughout these years, whenever my salary increased, I think the percentage of salary that I was saving also increased, right? So that incremental salary, most of it was going into my savings and investment, and that helped me. So I think that is one small thing that people should remember when they are expecting those salary hikes. But again, coming back to these specific rules, I think 2080 is a very good starting point. But again, this is very personal. For some, even 10% saving might be a bit of a stretch, and for some, they might be able to save even 40-50% as well.
Yeah. Okay, got it. So now we are a generation where we want things quick and fast. Most of us, we don't have the patience to play the long game, but we want quick returns. And that same applies then to investment as well. So many people out there are involved in cryptocurrency and FNO trading as well, despite being aware that as per SEBI, what SEBI tells us is that 90% of these investors are losing money. So, what are your thoughts on people who want to make quick money in the market and are willing to take these extreme risks for it?
So I think uh, that statistic that you mentioned, 90% people are losing money. I think it's more like more than 95% of the people are unable to make even the FD returns. So these guys would be better off if they just invested money in FD and did not do anything at all. So that's the statistics. And another thing is, again, I remember that most of the people who are not even involved in FNO but doing stock picking on their own or investing, because of the common mistakes that I shared, even I made in the beginning, they are even unable to make the index returns. So index returns, anyone should be able to make. It's pretty straightforward. There are so many index funds, mutual funds. You just invest your money there and forget it. You're not required to do anything, but that becomes very difficult for most of us as investors, right? We always feel that in order to move ahead in investing, we are required to do something, whether it is getting into FNO, whether it is figuring out which stock or which uh, market, how much it is going to go up or when it is going to come down. All of these things, in our view, becomes very important. And the noise, I don't blame investors because the noise in the even in most of the business channels or even on YouTube, if you follow most of these influencers, that is mostly what they are talking about. So I don't blame the investors for actually getting into it, but I think wealth creation, it's stock markets. We have seen, or we have started seeing stock markets as something using which we can grow rich very quickly. But that's not the case. It's just, I think stock market is one of the avenues where you save your investments, you can grow your investments over long run, but it's not a place where you can actually get rich very quickly. So I think that is a misconception that we are having. And I think the stories also that we see, some of the times people get lucky, maybe in cryptocurrency, maybe in one specific stock, they made huge amount of money. But that is not, most of the times, that is not due to skill. That is actually because of luck. It's just like winning a lottery, right? If somebody wins a lottery, it does not mean that buying a lottery ticket is a sure short way or a very good way of getting wealthy. Yeah, it does not mean that, right? Similarly, if we hear stories about people getting rich, most of the times it is because of luck. Whereas we do not hear stories where people have lost all the money, and like you quoted SEBI, uh, that 95%, 90% of the FNO traders lose money, but we never hear about them. We have never seen them. On YouTube, if you go, it feels like making money in FNO is really very, very easy. Almost everyone is making money and they want to teach you just by charging $1,000. That's how easy they claim it is, but it's never the case actually.
Yeah. I guess it's also because people only share the stories of their success and not their failures.
Exactly. Yeah, yeah, yeah. That's why we never hear FNO traders who are losing money. Never, almost never.
Yeah. So you also mentioned about stock picking. So with no prior experience, how does one go about investing in stock market? How to pick the right stocks and how much time one should research about the stocks.
Yeah. So I think one of the best ways to uh, get into stock market is index funds. So index funds are relatively very cheap and very good way of entering into stock markets. And secondly, spend some time mostly on learning things. But what is more important is, because there's so much noise out there in the markets, we tend to learn the wrong things. So what I think most of us believe when we are young investors is that to be a good investor, what I need is to learn to read financial statements. That is very much required. Or I need to learn technical technicals, using which I'll be able to find out when to enter a stock or when to exit a stock, or whether this is the right time to buy a stock or in the markets or not, or let's say learn FNO trading, or which sector is going to give me best returns. So, researching how to research a specific sector, how to research a specific stock. I think most of the noise out there in the market is about these things. So, abhi election aane wala hai, how should I create my portfolio so as to benefit from the election results? Or budget is there now, what should I do in my portfolio? All of this thing is noise. And mostly 90% of the stuff out there on the internet focuses on these wrong things. I think the right things to learn in the stock market, because everyone has its own full-time jobs and other things, right? And we have very limited time, very limited skill set. So it is very important for us to learn the right skills in our journey of financial education. And I think I can point out some of these things are like, learn how to do your own financial planning, or start with asset allocation. Figure out, take some, you can go to gullak.com, our website. There's a risk analysis, which can tell you, a tool which can tell you about how much risk you can afford to take that survey. It is going to tell you what is the asset allocation you should have. And I think asset allocation is one of the most important things that almost nobody talks about. It also learn about rebalancing, learn about concepts of long-term investing and compounding, learn about how market cycles work. I think these are the things, if you focus learning on these specific things and not on the wrong things, it is going to make your learning and your investing journey uh, relatively easier, right? Investing is never easy. I think the rules are simple to understand of investing, but it's very difficult for us to implement those rules, because what is happening is in normal times everyone can implement those rules. Where we tend to make mistakes is in the extremes, when the markets are really booming, going up a lot, and on the other side, when there is a lot of panic in the market and the markets are crashing, and the markets are crashed, let's say 30-40%, right? So learn about psychology of investing and how you can use it. And it really, it's not that you'll be able to learn overnight or in a few months. It takes lot amount of time, maybe even, actually it takes a lot of years for you to understand these concepts. So keep spending some time on it. But the other mistake that I see is, as I've told you, if you focus on learning wrong things and spend too much time there, it is very counterproductive. It actually helps you lose money faster, right? So focus on right things, and you don't. I think, don't worry too much about learning uh, in the markets, because the other mistake that most of the youngsters end up making is, instead of focusing on their career, they focus much more on their investing and how can I get few percentage points higher on my corpus. Whereas if you see, most of the youngsters would have very small corpus, right? तो उसमें अगर आप अपना पूरा कॉर्पस डबल भी कर लेते हो या रिटर्न्स डबल भी कर लेते हो, it's not going to really matter so much because your corpus is so small, right? So don't worry about how I can generate higher returns. Just focus on the basics. And second thing is, focus much more on your career, on learning the right skills. That is going to pay huge dividends. That is the best form of investment that you can make, focusing on your career. And I've seen many people, they focus much more on learning how to pick right stocks at the cost of their career. So that's what I have to say. Yeah.
Yeah. So you mentioned that it's very important for us to educate ourselves on topics like asset allocation, psychology of investing, compounding. So are
Yeah.
there any books or sources that you would want to recommend to the audience that they should read in their 20s?
So yeah, I think I can say couple of books that I really like. One is the most recent, Psychology of Money, Morgan Housel, and I read his blogs also. He writes amazingly well. He's able to understand these same, explain these same simple concepts in very many different ways. So Psychology of Money is one book that I really liked. Another, which is slightly more advanced, is a book by Howard Marks by the name of The Most Important Thing. And the third one I would say is Let's Talk About Money by Monica Halan. I think these three books are that everyone should read in their 20s.
Yeah. So even when I started off investing, I was a little bit apprehensive, but reading more about it, educating myself more about these topics, it made me more confident to invest in stock market. So I feel that it's always very necessary to educate yourself and keep reading about these things.
Yeah, and learn about history of stock markets. I think it's very important, and you'll get to learn a lot from reading what has happened in the financial markets over last 50 100 years.
Yeah. So, our next question is that all of us are on social media and we follow these financial influencers. As you mentioned, they call themselves as finfluencers, who are giving these advices left and right on what stocks to pick, what sectors to invest in. So, it can be a bit overwhelming for us to see who should we listen to and who should we ignore. So, what is the right way according to you?
So you're asking right way to select whom to follow.
Yeah, right.
I think one of the most important things is uh, you look at the experience of that specific person. I think that is very important in financial markets. Your experience over the years become very important. And if you look at their experience, you'll be able to figure out whether they are content creators or whether they are practitioners. So try to follow those practitioners. I think most of the content creators, I would say maybe more than 90%. There would be few, very few content creators who are doing a good job, but most of the content creators are they're not practitioners. They don't really understand what they are saying, and they end up saying a lot of things which hurt retail investors, right? I think if you want to follow, you really have to follow the practitioners who are present there and who are sharing their experience. And the higher the experience they have, the better it is. Also, see whether they are SEBI registered or not, whether SEBI registered RA or RA. That definitely helps, right? So yeah, those are the two things I think they should be practitioners and better with lot of experience. And if they are SEBI registered, well and good. That is something, yeah, I would want to say.
Got it. So, talking about asset allocation now, considering people in the 20s, most of us, we don't have much responsibilities and are willing to take more risks. So, would you advise us to invest 100% of our savings in equity, or should we also look for some other avenues to invest in?
Okay. So, Simran, I want to ask you, you drive a car. So would
Yeah,
you want to drive a car which has no brakes?
obviously not.
Obviously not, right? So how does brake help you? It enables you to go faster, right?
Yeah.
That's the concept. Even though your car has accelerator, but it's of no use if you don't have brakes. Your brakes help you to go faster because you can brake down and you can really save yourself. I consider debt in a portfolio like a brake, right? So if somebody is asking me, should they invest 100% of the money in stock market? That is like driving a car. You'll go very fast. You'll go very fast, but you're not safe, right? So I would never advise that. And maybe in last 3, 4, 5 years, the view is that who needs debt? When stock markets, I understand stock markets, I know understand how they work, and I've seen last 3, 4, 5 years. But I think when stock markets correct, they can correct substantially. Every 10 years or so, we see stock markets correcting by about 50%. And currently, maybe sitting at this point of time, we can make up our mind that whenever this happens, I will be able to go through that correction because markets would recover. All of this in theory looks very good, right? But when you are actually going through that correction of almost 30, 40, 50% and seeing your hard earned money that you have saved up across the years go down, you won't really, it's very hard to take that kind of loss. And I've seen people make huge mistakes by selling out all of their portfolio. They really can't even sleep at night and they just exit the markets. That's what happens. But right now, what has happened is looking at the markets and even looking at the correction of COVID, I think we have learned wrong mistakes. Sorry, wrong lessons. So one of the wrong lessons that I see everyone repeating or having learned in that COVID crash is कि COVID crash हुआ 30-40% market fell, but within 2-3 months it just recovered, right? So now the learning that everyone got, what everyone is feeling is stock markets में correction होते हैं, but within 3 months it will recover. ठीक है, but that's not the case, and that's why I was saying कि if you look at the historical history, what has happened, there's been many corrections which haven't recovered in less than a year. It has taken 2, 3, 4 years to recover. Even last 2008 correction, if you see, it took I think 2, 3 years to recover. Uh, you look at 2000, in fact, in the 2000 crash, Nasdaq fell by almost 70-80%. And if I'm not wrong, it took more than 10 years for Nasdaq to recover, right? So those recoveries can be painfully very slow and very long, right? And that is why I think asset allocation becomes important because it gives your overall portfolio a good diversification, and that pain during that corrections is much more easier to take. Plus rebalancing, because asset allocation and rebalancing go hand in hand. When I say somebody is following a 70-30 rule, which means 30% in debt and 70% in equities. So what happens if the market crash? Your 70% is going to crash like anything, but then you have that 35%, right? And when you rebalance, what will happen when you if market crashes, that 70-30 could become, let's say, 50-50, right? And then again you need to make it 70-30, which means you'll sell debt and you'll move to equity, which means you're selling debt at lower levels and buying equity at lower levels. Now let's say markets have doubled from there, then what will happen? Your 70% could become, let's say, 80 or 85%. At that time, again, to rebalance to 70-30 means you'll be selling some part of equity to make it 70% because it has gone over and above 70. So at higher levels, you're selling equity, at lower levels, you are buying. So rebalancing becomes a very good way of, very easy way of timing the market, and also it helps you save that huge losses. Obviously it's still being loss, but it will be much easier for you to go through that specific drawdown when it is happening.
A question that we often get asked in our other webinars as well. So, what is the optimal frequency of rebalancing?
I think there's no really what people can do is either do it, say, every 6 months. That's fine. Or the other way to do it is track the error in your portfolio. So let's say if the error is more than 10%, so let's say you're for like 70-30 portfolio, whenever your equity portfolio falls below 60 or it goes above 80, then you rebalance.
Got it.
Or you can rebalance every 6 months or every 1 year, something like that. If it depends on markets,
Hmm.
because it might so happen that in 2-3 years nothing really has happened and it's you're broadly tracking 70-30. Right. So it depends on market. I think that 10% rule is pretty good, that you follow 10% error rate. That is your threshold. And whenever it reaches that threshold, then you go and rebalance.
Yeah. Okay, so coming to the favorite topic of all our parents, insurance. So honestly, initially, the only reason why I also got my insurance was because my father was pushing for it. But now I understand the importance behind it, that it works as this financial net for all of us. So what, according to you, what kind of insurance should somebody in their 20s get, and why is it important?
I think insurance definitely is very important. I think almost everyone, we understand the need of insurance. And even I remember my parents also pushed me to buy insurance. And there were some relatives who were LIC agents, and they also sold me few policies. I think one thing that I would like to point out is obviously it is very important. How much insurance? That is one question. I think a general rule of thumb initially when you're just starting out is maybe it's good to get about 20x of your annual earnings. So if you're earning, let's say, about 5 lakhs every year, 20x of that is about a crore. So you can get 1 crore worth of life insurance. And because you are young, the premiums are also not very high. But don't mix insurance with investments, either through ULIPs or endowment plans. I think they are the worst of both worlds. You don't really get very good insurance also, and you don't really make any money in investing. So best thing is you keep these two separate. Don't mix insurance and investing, and just focus on term plan. Just buy a term plan from a good company, and I think you'll be fine. So yeah, here I think just if you don't mix these two things, uh, then that is okay. And if you buy early, obviously the premiums are low, so it makes sense for anyone to buy early.
Yeah. I think you might have motivated a lot of people over here to go and buy insurance now. So, talking about the next topic, so we all have our dreams, we all have our goals, and one of the goals that people talk about is retiring early. So, while the idea of FIRE, which is financial independence, retire early, it sounds really fascinating. I
Yeah,
personally am someone who I would like. I want to make sure that I'm not missing out on enjoying life in the present just because I want to retire early. So, what are your views on this?
I think fire. It sounds very interesting. Obviously, you go, you retire in your 30s, go to a beach and spend your life there. But it's not really that interesting right now because I think the fire, if we just split it into two parts, the FI part, which is financial independence, I think it's a worthwhile goal. Everyone should go after it in a meaningful and a balanced way. But retire early is not really. I think it shouldn't be really a goal for anyone, and especially for people in their 20s, because if they want to retire early, it means they don't really like their jobs. So I think it's it's a wrong solution to your problem, and the better solution would be to find out something that you really love doing.
Yeah.
Right? For me, it was investing in trading that I thought even after my engineering, I thought this is something that I wanted to do. And frankly, trading I could do even without getting paid. So I was lucky that I found that kind of work early on. But I think that's what the solution is. Retire early is not really the solution to anything. Uh, but the main thing is to figure out a job or some work which is meaningful to you and which you love doing. I think that is the solution to retire early problem. But financial independence, I think it's a worthwhile goal, but most of the people take it the wrong way. I think the way they want to approach this is I want to save like anything. I want to save, let's say, 60, 70, 80% of my income. And I want to be financially free as soon as possible. I think a better approach, first of all, it's not worthwhile or it's not feasible to save maybe that high an amount. 70, 80%. It's not almost not feasible for almost no one. Uh, yeah, that's what I would say. Yeah, there was one more point I wanted to make about financial independence. It just slipped out of my mind. Yeah, I don't know what it was, but yeah.
We can come back to it later if you
Yeah.
recall that. Yeah. So at the end, Vivek, if you could share some key financial mistakes that you have seen people make in their 20s and what can one do to avoid these mistakes?
I think one of the big things is uh, people are in a hurry to make money,
Mm.
and then we end up making a lot of mistakes. I think investing, if we are just talking about investing, it's really a long-term game, and don't be in a hurry to make money because I think the short way of reaching that financial independence goal is to take it slow, right? Uh, Second mistake that see a lot of people making is they focus much more on their investing journey and much lesser on their careers, right? They want to become better investor. They want to train. They want to learn anything and everything from say technical analysis to fundamental analysis and how to read balance sheet of companies, how to analyze sectors, but they don't really focus so much on their career. I think the one of the best investments that you can make in your 20s is invest in your career. Find out something that you really love doing, learn really valuable skills, learn how to get things done, how to add value. All of those things are much, much more valuable and they're the best form of investment, right? I think third thing I've already mentioned again is we learn a lot of wrong lessons from the market. It's very important to read the financial history to learn. I think that is one of the best ways to learn rather than watching influencers. Reading books about financial history can tell you a lot about how to go about investing in a good way. Yeah, so those are some of the mistakes that I think. And in this, when I said being in a hurry, I think what it results into is I want to pick the best stock. So that's what goes on in your mind. Ki, what is the stock that is going to give me the best investment, or which sector is going to do well after this budget? All of those kind of questions keep coming into your mind, right? If you are in a hurry.
Yeah.
Yeah, but these things never really work for anyone.
Yeah. Okay, thank you so much, Vivek. I'm sure that each of us over here watching this webinar would have learned something new, something different, and would apply that in our personal financial journey as well.
Yeah, it's always good to learn from others' mistakes.
Truly. So now we would be opening the floor to the viewers to ask Vivek some questions. So please feel free to drop in your questions in the chat box. We would request you to keep the questions limited to the topic that we are discussing today. In the meantime, Vivek, we also have a few questions from our good luck investors that were sent to us prior to the webinar. So if
Okay.
we can maybe address those first, I have them in front of me. So the first question is by Rajat. He says that many people say that in your 20s, you should not hold back and spend on experiences and building up your skills. So how to plan and track for various goals? Because while I want to spend on vacations, I also want to save up to buy a car and a home in the future.
Yeah, I think this is what the point I was meaning to make at that point of time, to have balanced, to live a balanced life. I think uh, living on either extreme, whether spending heavily and not saving anything, or on the other extreme of just saving and not spending,
Hmm.
none of them, at least to me, they don't seem right. Living a balanced life of both spending on your experiences and also building up your investing portfolio is the right way. So I think uh, living a more balanced life is a much better approach. And again, one of the things I think he asked is about how to track for various goals. I think one of the mistakes that most of these goal tracking apps, what they make is they assume one expected returns. So let's say I'm saving for buying a house, right?
Hmm.
My goal is I want to save say 10 lakhs for down payment of my house in next 3 years. That's my goal. So what these apps would do is they would take up one expected rate of return, which would be the average rate of return, and using that, it will show you this is how much you want to save. And that is just part of the story, right? That is one half of the story, because what we don't get is from that goal tracking app is what's the best case or worst case scenarios, right? So in 3 years, what are the worst case returns I can get? So if I want to save and the app tells me that I should save, let's say 15,000 every month, right? So what is the best case scenario? Instead of reaching 5 lakhs, what can I reach? And what is the worst case scenario? And knowing them is equally or more important than knowing the average case, right? So average case almost never happens. What happens is either you are above average or either you are below average. So while you are doing your goal planning and goal tracking, one of the most important things to ask is in these kind of scenarios, what is the best case scenario and what is the worst case scenario also. So I think that is something we end up missing, and that is a very important part in your overall goal planning journey.
Understood. The next question has been asked by the Panshu. I work at Fang. My RSUs have become a third of my net worth. Should I consider switching them to diversified products?
So yeah, I think we have heard a lot of stories in which people have made huge money through their ESOPs, right? But what we tend to forget is also there have been many startups who have failed, where startups valued at billions of dollars actually failed,
Mhm.
right? So we have both sides of the stories. I think again here I would want to take a balanced view, because whenever any specific position or any specific fund becomes too big on your portfolio, then you have a concentration risk. Here in this specific case, because you are working in that specific firm and most of your net worth is being tied to that firm, it's a big risk. It's okay, that firm might be doing very well, but it's risk nevertheless, because we see firms, anything can happen anytime, point of time, right? So just to avoid those kind of risks, because your job, your salary is also dependent. So if anything were to happen to that firm, your job is at risk, and also a big part of your portfolio. So I think it's a big risk, and my view here would be to diversify. He should start diversifying away and start selling these stock options and start booking profits and putting it into maybe other equity products or debt, or just to see. I don't know what his situation is overall, how diversified it is, but from what he's telling me, I think it looks way too concentrated on one company. Also, because his salary is also dependent on that specific company. So I think it's risky, and he should definitely start switching to other investment products.
The next question is by Udbhav. What should be the ideal mix of asset classes for long term investing? And what are the options, that is, the asset classes options for short term? And he has mentioned the period of 3 to 5 years.
I think ideal mix of asset classes. Uh, what we recommend is mostly financial products, and it's a mix of equity and debt. And if you want to know more about it, as I told you earlier, you can go to goodluck.com and take that risk survey, which will actually tell you how much of equity and debt you should have. I think maybe having a part of your portfolio instead of debt, it could be even real estate. Real estate will give you somewhere closer to debt, only slightly higher than debt, but not much. But then there are other things in real estate like large ticket size, and also the cost of doing those transactions is pretty high. But the upside in real estate is because of those things, that the cost is, it's not very easy to buy and sell. You end up holding real estate for much longer, which actually works in your favor. So that way, real estate is good. But overall, I think for most of your needs, uh, a mix of equity and debt should suffice. Again, I think here one good thing he has mentioned is that he's considering 3 to 5 years as short term, which is actually the case. Most of the times we consider 3 to 5 years as a very, very long term. It is not the case, really. I think 3 to 5 years is a really short term goal. And for this, you should be much more conservative in nature and not have too much of equity. I think equity should be, I can't really put a number, but it should not be very high. I think maybe somewhere between 30 to 50% equity is enough. And most of it, 50, 60, 70%, should ideally be in debt for your short term goals. That's what I would have to say. But I think in this, it's always good to consult an advisor, uh, a practicing financial advisor who can actually help you out with taking all of these decisions, because these decisions are mostly very, very personal in nature. So, two persons might be having the exact same financial goals, but their temperament might be very different, right? And because of which your asset allocation for these same goals could be very different.
Yeah. Udbhav has another question. Should I have home loan in my 20s?
Home loan in your 20s, I don't think it's a very good choice, really. I think real estate, again, just talking about it mathematically, I'm not taking into account the emotional aspect of buying your first home, and which obviously is very different, and that decision can't be made on Excel. What I can advise is just mathematically what works best, and what I can tell you is equities definitely hands down would give the best returns on your investment over long run, right? So delay this home loan as much as possible. Being on rent for the initial few years is I think it's a very good idea. It gives you the flexibility of moving around within your city also, and moving your jobs across cities also. So I think it's too early to have to buy a house in your 20s for most of the cases. And here I'm just speaking about it from purely from the returns perspective. As I told you, emotionally, having a house is for many, most of us, it's a very good and very good decision. So yeah, that's what I would say. So if you're just talking about purely in terms of investments, I think delay as much as possible. and maybe in your late 30s is the time you can go for a buying a house.
The next question is by Kishan. Hi Vivek, I am 33 and I have a hard time diversifying my portfolio. I have only invested in equities, 70 to 80% in small caps, and maybe 2% in SGB. Can you convince me to diversify more? Vivek, can you convince him then?
I don't know, Kishan. I think the good thing is he knows he needs that diversification. I think it's very, very highly concentrated in small caps, as he has said, almost 70 to 80%. But maybe, Kishan, what you should do is go look at what happened in 2008 to small and mid cap index. I think equity markets, large cap fell about 50%. So it's fairly easy for me to say that mid caps would have fallen more than that, maybe 60, 70% in fact, right? So whatever money you have in small cap, let's say it is say 20 lakhs. So would you be okay in seeing that 20 lakhs become maybe 5 lakhs, something like that? If you can take, I don't know many people who can take that kind of risk. So it's always good to be diversified across equities also and across asset classes. That's what I can say. I don't know whether it's good enough for you to convince you, but the good thing is at least you know that you need to diversify.
Yeah. Next question is by Santosh. As an entrepreneur, how to plan personal finances in the late 20s?
Yeah, I think it's quite tough being an entrepreneur. Obviously, being very very stressful, and I don't know the situation, how much money you're taking as salary from your business, all of those things. But I'm guessing you being an entrepreneur in your early 20s, you're just setting up that business and the income is also not very stable. So I would say in that case, not to put too much money into equities because the source of your income is not very, very stable. So what you need is more stability. So as a portfolio, I think you should have a much safer portfolio and have much smaller part into equities. Like I always think that, let's say somebody being in a government job, he has a stable, very stable job, and they can afford to put much higher percentage into equities because their income is more, very, very stable. And the entrepreneur is almost at the extreme end, and he or she should have much lesser part in equities as compared to debt, have a big part of overall your portfolio in debt, at least till the time your earnings are more stable. That's what I can say from the limited information that I have.
Okay, so the final question that we received was from Prabal. I am a 25-year-old working professional with a salary of roughly 80K per month. The next big expense for me is my marriage. Thankfully, I don't have any debt on me. How to plan my investment journey from this point of view?
Okay, so uh, about 25 years of age, earning 80K, and how he should plan. So I think first thing, obviously, it goes without saying, is insurance and uh, an emergency fund. I think these are the two things to begin with. Obviously, insurance is term insurance, but in terms of emergency fund, you can look to build your emergency fund, maybe not uh, immediately, but over, let's say, next few quarters, right? So, but start saving for your emergency fund also. Second is start building your, I think, focus, because you're just starting out. It should be focused much more on mutual funds and much lesser on individual stocks. Even if somebody wants to do individual stocks, it has to be through some advisor, but never indulge in individual stocks on your own. So start building out your mutual fund portfolio, looking at the asset allocation that you should be having, right? Another advice to you would be your savings should increase at a faster pace than your income. Otherwise, it's not going to work out, right? It's very, very difficult to gain that financial independence. So it has to be that your savings are growing at a faster pace, and lastly, what I would say to you is focus limited time on your investments, uh, but focus on learning the right things. What I mentioned earlier, and not on focusing on learning the wrong things. Wrong things would take up a lot of your time, and it's going to really create a hole in your portfolio. Just focus on learning the right things. I think these are some of the things I would have to say to you.
So, Prabal, I hope your question was answered. Let's look at some of the questions that we have been receiving on a live chat as well now.
Okay.
Uh, so, the first question is that at what age we should buy a house from the time most will start an EMI?
Yeah,
So, I think,
think, sorry.
yeah, Vivek, please go ahead.
Yeah, I don't know what age, but when you are finally settled, as in, you are going to remain in that specific city. So I don't think that 20s is the time you should think about buying a house. I think when you are settled, when you have built up a decent equity-based portfolio also, and when maybe you are married, you want to raise a family. So maybe in your late 30s is the time I feel works well if you're not looking to move cities, right? Maybe by that time you would have had about 10 to 15 years of experience, and maybe you're just looking to stay in one city in that time, and that is the time maybe you should think about buying. And one very good thing which we ignore is, I think that's section 54F, if I'm not wrong, but where it helps you is your equity investments, whatever profits you are making, obviously you are liable to pay some long-term or short-term capital gains tax on it, right? But if you use that money to buy a house, buy a residential property for yourself, then you actually don't have to pay those taxes, right? So even if you're booking your overall long-term profits, you don't really need to pay, you don't have to pay those taxes if you end up spending that money in buying a house. And I think that's a very good way of buying a house. First, build up that equity portfolio, let it compound over years, at least a decade, the more the better, and then use that money to pay down payment, a decent part, and then buy a house. That's what I heard.
Okay. Next question is by Rajat. Should we go for term insurance or life insurance or both if we are in our mid 20s?
So term insurance is a kind of it's life insurance only. Only thing is term insurance, in term insurance what they are taking is only the premium, right? The other is either ULIPs or endowments where they take a part of the money that you pay goes into your insurance premium and rest is invested, right? So I think insurance, term insurance is the only way you should go about not investing, but buying an insurance. That's the only way. Do not buy any product, no matter how good it feels to you. Do not buy any product which mixes insurance and investing. Most of the time, the fees is very high, and the investment product is not really very good. Right? So go for term insurance only.
Got it. So he has asked another question. What are the debt options that we can invest in?
What are the debt options?
Yes.
Yeah, again, it's not a straightforward way, but what we would be doing is, I'll just refer back to Good Luck. What we are doing in Good Luck is also, till now we have been advising a lot only on stocks, but we are very close to finalizing our model portfolios. We are doing our research for the past couple of months, and we'll be creating these mutual fund portfolios as well, right? I think in that we'll be able to create portfolios for different risk profiles because there are many debt options, and it depends on uh, your risk profile also, and it depends on your goals and how much money you are investing, all of these things, right? Because in debt and even in equities, they were supposed to make your job easier, mutual funds, but now what has happened is there are tens of categories, maybe 30 to 40 categories overall, and thousands of mutual funds. So picking up mutual fund also is not a very straightforward, very easy or straightforward job. So yeah, look out for the portfolios that we'll be creating, because it's not really easy for me to answer this question here just by very limited information that we have.
So I also see a few questions about Gullak and ST. So for people who are joining us for the very first time, we also hold monthly webinars where we address all your questions about Gullak and ST. And if you still have these questions, you can always reach out to us at our support number and email, which are present on our Gullak website. Okay, so the next question is by Shailesh. Does each goal should have a set of assets like small cases, mutual funds linked, or should it be one unified portfolio for all goals?
Yeah. See, I personally have one single portfolio. That's the way I like. Again, mathematically, we have done a lot of research internally in Gullak on how one should go about creating these portfolios and what are the advantages, disadvantages of each approach. And what we believe is having a unified portfolio is much easier to manage and also much better to manage, right? So, but I also know many investors that speak to me individually. They say that they are unable to track these goals if they have a unified portfolio, and they much rather have separate portfolio for each goal. But overall, I think a unified approach is much simpler, much better in terms of planning your goal. And I personally also use a unified goal tracking and Excel basically that I've created for myself and I've been maintaining over the years. That helps me a lot in tracking and planning these goals.
The next question is by Vivek. I am a doctor, a government employee. Should I buy term insurance? I'm covered up to 30 lakhs. I have invested in Gullak Gear 6 on 2nd May.
Sorry, I couldn't hear you. There's some issue. Let me quickly read this question.
Yeah. So it's this first question asked by Vivek.
Yeah, so Vivek, I think your first question is, should I buy term insurance? I'm covered up 30 lakh. I think yes, Vivek, there are multiple ways to figure out how much of term insurance. One basic rule that I've shared is to have term insurance of about 20x of your overall annual earnings. But there are other ways in which you can figure out how much you need to make, but at least have that 20x of your overall uh, annual earnings. That is one thing. Second question is, should I book profits? I'm new to small case. I book profit for the stock which I profit. So Vivek, I would encourage you, as Simran said, to attend our monthly webinars. In that, we are happy to cover any questions that you might have related to small cases. Okay. Yeah. Should I do lump sum or SIP? I think SIP. Let's just leave it at that. But we'll be happy to cover all of these questions in our monthly webinar. For this, let us focus on our financial planning and not stock or portfolio specific questions. Okay. But regarding term insurance, I have already told you 20x is what you should look at. Or if you want to get deeper into it, uh, there are two ways to actually, I'm getting much more deeper, but there are two ways to figure out how much insurance. One is based on your overall earnings that you are expected to uh, uh, earn over your overall career, and you find out a present value of all of those earnings. That is one way. Second way is looking at your goals, and to fulfill your goals, how much money you need. That is another way you can find out. And what we are doing is, you should go and check out goodluck.com tools section, which there are a lot of these kind of tools that can help you decide on most of these questions. And this specific tool of how much insurance that we have within a week on our website. So you can go and check out exactly using that method how much insurance you would need. Yeah. Okay.
We have one more question from Rahul. I want to build a corpus for my daughter, 2 years old, for next 20 years. Any safe options other than Sukanya Samriddhi?
Sorry, I couldn't hear clearly, but I think what you said was he wants to build a corpus for his daughter, uh, who is currently 2 years old. Is that what you said?
Yes, yes, and he wants to build it for next 20 years.
Okay. I think 20 years is a fairly long term. Uh, few of my initial thoughts are you should not really buy any uh, off the shelf plans like children's education plan. They are almost always very, very costly. That is one thing. Second, I've already spoken about insurance. I think in these kind of things, insurance becomes very important. So have adequate term insurance. Thirdly, because this is slightly longer term goal, and if you have that kind of risk appetite, go for a equity heavy portfolio, mostly through mutual funds and index funds. I think they would be good, but have a good equity heavy portfolio. And finally, there's a concept in goal planning which tells you uh, how much you should shift from equity to debt towards the end of the when you are about to reach that goal, right? So during maybe last 5 years, so up until 15 years, be equity heavy. But when you are about to reach that goal, so from year 16 to 20, keep shifting a good part of your portfolio from equity to debt so that last 2, 3 years it should be primarily in debt. That's how the planning of this kind of a goal should be done. Uh, yeah, I think those are the points that one should take care. Uh, Another point is whenever you are planning, you would have done some sort of analysis as to what are the expected returns. And because this is a very important goal for you, your daughter's education, I think what you should do is don't assume very high returns from the market. Because what you want is obviously if you get those returns, well and good. But what you want is you want to reach that goal with much more certainty, which means even if the markets are not as good that they have been in last 20 years. So let's say markets in the last 20 years have given about 14% returns. You should not expect 14% returns for the next 20 years and then plan this journey. You should be much, much more conservative in nature and take much lesser rate of growth for your portfolio so that even if you're not surprised to the downside. So the surprise then only becomes to the upside. So be more conservative in your overall expectations from the market and from your portfolio.
Okay. Shailesh is saying thank you for your inputs on the unified portfolio. Is it possible for you to share the template you use to track? I find it challenging. Thanks and appreciating your clarity of thought.
Yeah, Shailesh, I'll be happy to share that template. It's a very crude one. Even if I share currently, I don't think anyone will be able to understand. But let me work on it a bit and we'll refine it. And definitely, if that is something that is helpful to others, I'll be happy to share that. Right. So let me work on it a bit, and maybe in next couple of weeks or 1 or 2 months, I'll be happy to share that template also with everyone.
That were all the questions that we could find in the chat about this topic. So, thank you so much, Vivek, for sharing your wisdom, and thank you for everyone who joined in our session.
Thank you, Simran. Thank you, everyone. Thanks a lot.